Good morning. Last time we talked about what's GDP, and as we said, GDP is the market value of all final goods and services produced in a country during a specific period of time. As we said, this definition has four keywords. They are market value, final, in a country, and specific period. Then we talked about the circular flow model and the connection between the four sectors of the economy through the three markets. Then we talked about measuring GDP, and as we said, there are two different approaches for measuring GDP. Expenditure approach and income approach. Using expenditure approach, GDP is calculated as C plus I plus G plus X minus M, where C is consumption expenditure, I is investment, G stands for government expenditure, X stands for exports, and M stands for imports. X minus M is net export. What about income approach? As we said before, there are four main factors of production, which are land, labor, capital, and entrepreneurship. So land earns rent, just the same words or the same meaning, but using different words. So instead of rent, it's gonna be rental income. Labor earns wages. So instead of using the word wages, it's gonna be compensation of employees. Capital earns interest, so it is net interest. And finally, with respect to entrepreneurship, entrepreneurship earns profit. But here we have to differentiate between whether it is a corporate or sole proprietorship. So it will be corporate profits and proprietor's income. So these are return to factors of production. So if we are going to add all of them together, this is known as net domestic income at factor price. But we would like to convert it from factor price to market price, as by definition GDP is the market value, not the factor value. So we have to convert it using indirect tax and subsidies. So we have to add indirect taxes minus or less subsidies this will be net domestic income at market price. Now we would like to convert it from net to gross, as it is gross domestic product, not net domestic product. So we have to add depreciation this will be GDP using income approach. So we can conclude that if you would like to convert net item to gross item, you are going to add depreciation. So say for example, if you would like to calculate net investment, it can be calculated as gross investment minus depreciation. What's meant by depreciation? Depreciation means decrease in capital stock due to tear and wear, or in other words, resources are capital is depleted. Okay. Example. If you are given the following, Okay, given this information, calculate GDP using two different approaches, income approach and expenditure approach. Let's start with the expenditure approach. As we said, according to expenditure approach, GDP is calculated as C plus I plus G plus X minus M. Consumption is 1,000 plus I. This is net investment, but we would like to find gross investment. So we have to convert net investment to gross through adding depreciation. So gross investment is calculated as net investment plus depreciation. Net investment is 200 plus depreciation, which is 50, so it's 250. Plus government expenditure 700 plus X minus M, so it is net export negative 100 So if you are going to add 1000 plus 250 plus 700 minus 100, this will be GDP using expenditure approach. It will be 1850. Now GDP using income approach. As we said, it's the summation of rental income, corporate profits, proprietors income, net interest, and employees compensation. Employees compensation 1500, corporate profit 200, proprietors income 100. 1500, corporate profit 100, proprietors income 200. Rental payment 50, net interest 20. 50 and 20. We have to add the 5 items together in order to get net domestic income at factor price. $1,870. If you would like to convert it from at factor to at market, then we are going to add subsidies minus taxes. Subsidies is 150 and taxes 100. So the difference between subsidies and taxes is 50. So this will be net domestic income at market price. It will be 1,920. And finally, we would like to convert it from net to gross. So we are going to add depreciation. Depreciation is 50. So it's 1,970. This is GDP using income approach.